everybody. It's a difficult act to follow Muhammad Yunus, but fortunately for me, progress is 1% inspiration, 99% perspiration, and he was inspirational. I will provide the perspiration for you all. It's an honour to be invited to speak here today and to join this otherwise illustrious panel with Megan and Tom, and I congratulate Imperial on assembling a great programme for today. My theme today actually builds a little bit, a tiny bit of what Muhammad said, which is the need for finance to be focused not on finance, but on the real economy it serves. The title of this speech is regulating the square mile for the good of all 94,000 square miles of the United Kingdom. And the main theme is that to do that, regulation needs to keep up. Keep up with the macro trends, keep up with the way the system is reshaping. And we are here today almost 5 years exactly since the birth of the UK's post-crisis framework for regulation. A set of reforms that brought with it the twin peaks of a conduct supervisor, the FCA, and a prudential supervisor for banks and insurance companies. But the novel bit, the addition, was the addition at the top of those twin peaks of a macro-prudential lookout, a macro-prudential committee, the Financial Policy Committee of the Bank of England, whose task was to look up and out from the rules for finance, the square mile, to the outcomes it was delivering for people in the real economy, for all 94,000 square miles of the UK. The duty to look up and out, the outcome that it seeks is a financial system that serves households in bad times as well as good. A financial system that doesn't disrupt, but that does deliver. We used to have a very short and snappy soundbite that was that we wanted a financial system that was strong and stable, but we forgot to trademark that. And it was appropriated and somewhat abused. So that's the outcome. The power, where the rules don't do that, change them so they do it. So it's outcome focused. Now the addition of that lookout to the Twin Peaks is in a way a reflection of the obvious. The fact that there is no rule book, however long, however detailed, like Dodd-Frank, that is the rule book for all seasons, let alone all time. So the new system effectively hardwired into it the duty for regulation to keep up. The crisis, of course, was the evidence that that hadn't happened before across advanced economies. Regulation hadn't kept up with the risks the financial system was taking. It hadn't kept up with overvalued housing markets and financial markets in the United States. It hadn't kept up with a commercial real estate boom in the United Kingdom. Nor, of course, had it kept pace with the way the financial system worked, with securitization, with SIVs, and with CDS, all those things that nobody had heard of many years ago. The result is worth, as memories fade, etching on our collective memory. A near collapse of the Western financial system and a sideswiping of the global economy of fairly epic proportions. In the UK alone, 1 million extra people made unemployed, and over time, lost income for everyone in the economy, equivalent to a bill of £20,000 per person. The post-crisis reforms, I think, embody the lesson of that. They embody the need to keep up with the risks the system is facing and with the shape of the system as it evolves. Today, recognizing my obvious conflict of interest in answering this question, I want to look at how successful we've been in building a system that is efficiently resilient, building a system that can serve the economy in bad times as well as good. And then I want to look ahead, to look out from this lookout to the macro trends and the challenges for regulation in keeping up with them. And the three I want to talk about are Brexit, borrowing, and the unbundling of banking. So to kick off our discussion, looking back, we have corrected many of the fault lines that underlaid the financial crisis. And in particular, the banking system has been strengthened. Not everyone agreed it should be strengthened so much. I'm sure there are people in this room who don't agree with that. But frankly, it was obvious it needed to happen. It needed to happen because the economic costs of major banks getting into trouble are vast. So they have to be able to withstand very severe economic circumstances. And that's why we stress test them to economic scenarios even tougher than the financial crisis. But that resilience, that raising of bank capital levels, had a reason. Firstly, it created the confidence that was necessary for banks to get lending again. It also allowed us to withstand some turbulence too. So cast your minds back to July 2016, in the wake of the referendum. Financial markets are bank share prices and property company share prices are pricing in a fairly severe downturn in the UK economy and in property markets. Share prices are basically factoring in a rise in unemployment to about 7.5%, 20% falls in property prices, and a 4% fall in output over time. But banks had been tested to survive something twice as severe as that. So confidence in the banking system could be maintained, and remarkably, by past standards, banks' funding costs didn't move. Banks were able to avoid reining in and actually making this downward expectation somewhat self-fulfilling. So we saw there the first example after the crisis of a system being able to serve the economy in what at least at the time were perceived to be bad times, as well as the good. Now, it would have been easy in the aftermath of the crisis to swing the regulatory pendulum right the other way and to demand that banks fund themselves with really very high levels of bank capital. There have been some academic papers on this subject by Miles David and others. The system would certainly have been safer. I was going to say there is a respectable academic case for this point. But actually, two changes in our view mean that we do not need to supercharge levels of resilience further. The first is the advent of legal regimes to resolve failing banks. Now, there's more to do here, but so long as it's done, the cost of bank failure in the future can be somewhat lower in the past. And the second change is actually this duty that's hardwired in now for us to keep up with the risks as they change and with the system as it changes. So you don't need your baseline level of resilience to be supercharged for levels of risks that prevail only some of the time. But that, of course, makes it all the more important that we keep up with the macro trends and keep up with the risks as they evolve. So that turns me to the macro trends and the challenges they present for keeping up. The first of those is, of course, Brexit. Is that the time? The challenge for us, at least, for Brexit, is to keep finance capable of serving the economy through it, whatever form or flavour it takes. The first condition for that, straightforward, UK banks must be able to withstand, and by withstand I mean keep lending through whatever the macroeconomic consequences of Brexit may be. In our judgment, that condition is met. It's met because, however you look at it, even the most severe economic scenarios that could be associated with Brexit are encompassed within the stress tests we've already performed on banks. They can pass those tests, so they can pass the Brexit test as well. But in this case, that's not enough, because barriers to delivering services across the channel could disrupt the end users of finance on both sides. Now, the UK, of course, is a net provider of those services, wholesale financial services, so the end users there are at most direct risk of disruption. But the end users here could also suffer some disruption too. UK investors invest in funds domiciled in the EU. There are 10 million UK insurance policyholders whose insurance is with EU companies. There are 77 branches of European banks that operate here in London, providing services both to the EU and the UK. And that's why, from the very start, we've overseen contingency planning across the financial system. And because it would be difficult for all the actions by all the necessary players to be taken by March 2019, we were very early in calling for a transition period. So for us, the recent political agreement on a transition period is welcome. Now, there was always going to be an interlude between the political agreement and the legal certainty. So the authorities of here have done what our collective mandate to keep the system capable of serving the economy actually implies. And that's to give underpinning to the political agreement on the transition. So European firms can assume that they'll be able to operate here and serve customers here in the UK, much as they do now, until the end of 2020, because that commitment is backstopped by a UK government commitment to legislate, if necessary, to allow European firms to operate and serve end users here after Brexit. The economy of the UK, at least, can be confident that, whatever happens, it can access financial services as it does now. And it's an example of looking at this through the lens of the users, the real economy, it's Mohammed's bifocal lens, rather than from the perspective of the financial system itself. So that's the first trend. The second trend that at the same time we have to keep up with is the risk-taking in the financial system itself. Now, with credit markets priced for perfection, the riskier forms of corporate lending are showing signs of stirring. The pickup in consumer credit has been well publicized in this country. But today I want to turn attention to a third factor, which is the mortgage market in the UK. Because even though the numbers here are on the face of it less interesting, what lies beneath may actually be more interesting. So overall mortgage debt has been growing steadily. But underneath that calm surface, a sharp slowing in credit demand from buy-to-let borrowers as tax changes have come in, and from owner-occupiers whose incomes have been squeezed, has actually been offset by a loosening of credit standards and an expansion of credit supply to owner-occupiers. Mortgage rates have fallen materially relative to bank rate, especially at the riskier end of the lending spectrum, and lenders are now prepared to take more risk. Loan-to-income ratios are rising. So why do we care? Well, households with high levels of mortgage debt make cutbacks in downturns to keep paying the mortgage. More of these households in an economy typically means deeper recessions. It's an intuitive result. There's a body of evidence that supports it. And that's why when it comes to mortgages, the view from the macroprudential lookout is that the economy can be best served by actually putting in place guardrails that guard against excessive risk-taking by lenders. And we put those in back in 2014. They're centered on a limit on new mortgage lending of 4.5 times income. And with lenders now prepared to take more risks, those guards are now working. They are hitting up against those guards. So the proportion of new mortgages just below that level, that 4.5 level, has risen from 12% to 18% of the flow. We are, it looks like, constraining the risk-taking that banks are prepared to do. Now, in part because of that, household mortgage debt servicing burdens remain very low. Only 1.4% of households spend 40% or more of their income on their debt servicing. And even if interest rates were to jump very sharply to 2% overnight, that's not a forecast, by the way, even if they were to do that, only 1.9% of households would have a debt servicing ratio above 40%. And that 1.9 is in line with the average number of such households in the past. So there's no flashing warning light here on the dashboard telling us to pull over. There is perhaps the light that tells you to take the car in for a checkup and a service, because developments in corporate credit, in consumer credit, and now under the surface in the mortgage market may be signs of a more generalized pickup in risk-taking. And when risk-taking increases, we must not allow it to happen at the expense of the resilience of lenders to any future downturn in the economy. They have to remain capable of serving the economy in any future bad time, as well as the good. Now, our annual stress test provides the basis for checking that, but in this environment, we think more regular checkups are needed too. And that's why, as we said in March, we will consider the adequacy of capital levels of banks in June with a focus on these indicators of increased risk-taking, so that we can keep the standards up, keep regulation up with the risks the system is taking. The third macro trend, the final one, is actually the need to keep up with the way the system itself is reshaping. Banks are no longer the only institutions with the data to actually efficiently lend, particularly to small businesses. We've seen in the East the growth of Ant Financial, and in the West the growth of Amazon lending. But bringing the focus a bit closer, I wanted to look at trends within the banking system. Because in part due to regulatory efforts to level playing fields, banking is becoming more competitive. Smaller banks are taking market share. In the past 12 months, smaller banks in the UK that account for less than a fifth of the outstanding stock of lending have actually contributed a half of the flow of new lending. So their newfound importance in the supply of credit actually means that even though they're individually small, collectively, their collective risk-taking is now of relevance to the whole economy. And that trend in greater competition within banking should continue as payments reforms and open banking reforms actually begin to kick in. Because by allowing customers to connect to a range of banks, a range of financial services through a single point, open banking could open the door to the unbundling of banking services. What do I mean by that? Well, first of all, deposits could become more sensitive to the returns that are being offered. The ability of large incumbent banks to pay less for deposits than others is actually worth about £1 billion a year in interest margin. That could be competed away. And it will become easier for consumers to separate their payments service from their banking service. And this is the unbundling. The Bank of England is playing a lead role in that, in particular my colleague Andrew Hauser in the audience here, so all questions to him. We're playing a lead role in that by giving people, provided they meet the relevant standards, access to the UK's real-time gross settlement system. And the first non-bank payment service provider went live a week ago, and a number of others are set to join over the coming months. This means that they will in time be able to gain access to the UK's payment systems, including the world-leading faster payments system. This, of course, should spur innovation. Opening up to new payment providers should spur innovation, increasing choice, and reducing costs for consumers. But regulation is going to need to keep up with that to make sure the benefits to the economy in the good times don't come at the expense of disruption in the bad times. How? Well, just quickly, first of all, we have to manage the response of the incumbent banks. We've tested their possible responses in an exploratory exercise last year, and supervisors are, in the polite phrase we use, having discussions with banks about those responses now. The second is that existing bank liquidity regulation may need to adapt. Regulations currently treat deposits from households and companies as stable funding. But as open banking develops, and in particular as people set up maybe automated account sweeping, deposits may become less stable. And that will need to be monitored very carefully as this thing develops. And third, frameworks for operational resilience, particularly cyber risk, will need to evolve as well. And that will be, I think, a focus of the next session. Now, that sort of resilience is vital. That's why we're establishing clear expectations for banks and other important institutions for their ability to recover essential services from a cyber attack. And as customers increasingly access the system through these third-party aggregators and through other payment service providers, we must make sure that that doesn't compromise the resilience of the service they receive. The FCA has set out what it expects of these providers, and we'll work together to ensure that as they become more important, and the system relies more on them, that their resilience, their operational resilience, keeps pace with their importance in the system. Because none of these trends are to be stifled by regulators. In fact, they are to be spurred by regulators. Our job is to enable them, encourage them, and make sure they achieve their full potential. Which, you'll be pleased to know, brings me to the conclusion. Because 5 years ago, when we kicked off this regulatory framework, nobody had really conceived of this unbundling of banking. In the wake of the crisis, any return of borrowing seemed a long way off. And believe it or not, Brexit wasn't even a word. The polite version of the lesson of this is that stuff happens. And because it does, we all benefit from a financial system that can serve in the bad times as well as the good, a system that doesn't disrupt but does deliver. No set of rules, though, will deliver that for all time. So this regime hardwires into it the duty to look up, look out, and keep up. Keep up with these macro trends so that whatever happens, regulation of the square mile delivers for all 94,000 square miles. Thanks very much.